the GMD and CEO of Kari Asset Management Limited, in the person of Mr. Johnson Chukwu, will be taking us through this journey.
Miracle, we lost you. Okay, I think we can go ahead so that we don't keep people waiting. Okay, good afternoon, everyone. I need somebody just indicate they can hear me so I can move on. You can put that on the chat.
Yes, sir, we can hear.
Okay, you can hear me?
Yes, sir.
Okay. Okay, good afternoon, everyone. We'll be speaking today, and once again, we welcome you to our webinar session, and we are quite appreciative of your consistent attendance at this webinar, which we hold every quarter. The webinar is basically intended to share knowledge and make our knowledge available to all our customers and non-customers alike, free of charge, so that people can take advantage of some of the things we share at this webinar. So I'll be speaking on basically the Nigerian economic and financial market review for the first quarter of this year and what we think will happen for the second quarter of this year, or Q1. So you can say Q1 and H1 2024, but more of the Q1 is actually historical now because the first quarter is now behind us. So we'll be reviewing what happened in the first quarter, while at the same time we'll be taking a preview, a preview of what we think will happen in the second quarter of this year. We'll start by looking at the global economy generally. Of course, you really can't talk about the local economy or national economy without looking at what's happening globally, because what happens globally will obviously affect what happens to you locally. At the global level, the International Monetary Fund has actually predicted that the global economy will grow about 3.1% in 2024 and grow about 3.2% in 2025. This is basically attributed to expected improved performance in the US. As you may recall, the US economy grew at 3.1% last year. And we're also seeing a lot of corporate fiscal support by the Chinese government to Chinese businesses. We're also seeing some improvement in performance by some of the big emerging economies of the world, like India. India has continued to record very steady performance in terms of economic growth. In the first quarter of this year, we saw oil price that became unstable. We saw oil price threatened, oil trade threatened by missile attacks in the Red Sea. Interesting, in the current quarter, 2024 second quarter, it looks like that threat is exacerbating as we saw the tension between Iran and Israel in the past few days. According to the World Trade Organization, the world trade is actually projected to grow at just 3.3% in 2024 and then 3.6% in 2025. That's below the historical world average of 4.9%. Hopefully, this is, it's expected that this is being called the slow in the global trade caused by geo-economic fragmentations. I just mentioned the issue of oil trade, oil activities that has not improved as a result, or that are going through some challenges as a result of the tension in the Middle East. And then you're also dealing with situation where the Russian bloc or the Russian nation and some of the countries like Belarus that are loyal to the Russian Federation are not trading smoothly with the Western countries. So you have some level of geo-economic fragmentations occasioned by political tensions, part of it as a result of the Russia-Ukraine war. Global inflation has continued to moderate. It's actually moderating faster than most expected. We saw a moderation in the countries like UK, Canada, the Eurozone, all witnessed moderation. However, on the converse, the US saw an uptick in inflation rate from 3.15% in February to 3.48% in March. The World Bank is expected IMF is predicting that the Federal Reserve Bank and most of the central banks in the world will begin to dial back on interest rates as a result of a moderation in inflation rates. So it's expected that in the second quarter of this year, we should begin to see a moderation or a dial back or reversal of high interest rates that we witnessed so far in the past couple of years as a result of the COVID crisis. So federal bank, reserve banks like the Federal Reserve Bank, the European Central Bank, the Bank of England, however, kept their rates steady so far, but it's expected that in the coming months, hopefully the projection is that from July, the Federal Reserve Bank and the Bank of England will begin to dial back on interest rates. You may as well have heard that, or you may as well know that the Russian president, long-living Russian president, who has been in power since 1999, won a sixth term as the president of Russia. So there are several opinions about the impact of his next 6 years governance on the war between Russia and Ukraine and the relationship with the Western countries. Like I mentioned earlier, Mr. Vladimir Putin has been in power either as prime minister or president of Russia since 1999. Children born there are 25 years old now. So that will tell you how long. In fact, he's the second longest ruling president of anything called Russia, either USSR or the Russian Federation, since apart from Stalin. Then at the local level, we saw the Q4 GDP of Nigerian economy expand at 3.46% in Q4 2023, sorry. That was a 13 consecutive growth. But at the annual level, the GDP only grew by 2.74%. We're going to talk a lot more on this. That was a further decline from a 3.1% growth in 2022. Inflation rates, I had mentioned earlier. Okay, I don't think I mentioned that. Nigeria's inflation rate surged to 33.2% in the month of March. And the report published by Nigerian Bureau of Statistics yesterday indicated that Nigeria's inflation moved further up from 31.7% it was in February to 32.32% in March. That was primarily attributed to food inflation, which we saw at a 40% level, the highest since 2005. The food inflation at 40%. And then with the inflation rate at 33.2%, the highest in 28 years. In its bid to fight inflation, the central bank increased the monetary policy rate within a month time space from 18.75% to 24.75%. It first increased to 22.75%, an increase of 400 basis points, and then further increase of 200 basis points in March to 24.75%. The implication of this is that we're seeing deposit rate go up, we're seeing lending rate go up, we're also seeing even Nigerian corporates struggle to borrow money from the banks. And then we're seeing this intermediation with corporate Nigeria or major corporates coming to the market to issue commercial papers at even as high as 25%. I'm sure we know of the internet outage, which affected Nigeria severely. It happened largely it affected mostly the West African coast, Nigeria, Ghana, Liberia. We're yet to see the impact, we're yet to assess the impact. Maybe by the time the Q1 2024 GDP figure comes out. Remember that the ICT sector is the second largest contributor to the economy. It contributed about 17% of the annual GDP economic activity in 2023. So there were some days of outage, and it would have affected them, including the financial sector that relied on technology to execute their transactions. The FX market, which is also a topical issue apart from football, Nigeria, and Discord, they talk about inflation, they talk about FX. Nigeria's FS market witnessed one of the most volatile performance in its history, the history of Naira, since Naira was introduced. We saw Naira gyrate to as high as, it started the year at about 1,215 Naira, and then gyrated to as low as 1,900 Naira to $1 at the parallel market. At the official window, the Naira started the year at a level of 907 Naira. It went as low as 1,627 Naira, 40 kobo in February. But interestingly, Naira has recovered back to 1,080 Naira to $1 at the parallel market and 1,136 Naira to $1 at the official window of the market as at the close of trade business yesterday, April 15th, 2024, sorry. Then at the stock market, we saw a stock market gain 39.84% in Q1, in the first quarter of 2024. But unfortunately, it started with Q2 2024 with some red. So we are seeing some bleeding in the market. We'll talk more about that as we progress in this engagement. What is the outlook on Nigerian markets in Q2? We think the outlook will be mixed as CBN hike is creating increased investors' interest in fixed income instruments. We've seen the central bank take out, between the central bank and the DMO, they would have about 12.7 trillion Naira from the economy, because at yield of on 364-day bills, at some point it was as high as 21.49%. Yes, last Friday's auction, the market, the yield for the 364-day instruments was at 20.7%. So we saw some minor tapering at the last year's auction. So like I said, we've seen the central bank withdraw, within the central bank and DMO withdraw as high as 12.7 trillion Naira from the economy. So this is having multiple impact on the economy. We are seeing the real sector of the economy struggle. I mentioned earlier that the blue chip companies are coming to the market to now issue commercial papers at 25%. Funding real sector operation for the blue chip company that used to borrow at 12-30%, it's going to be very tedious for them. It's going to be very, very difficult. But most importantly, small and medium-scale enterprises are not able to access funding at current rates. I know of a customer who a bank offered to lend money at 45%. And you can imagine what will you do with the money at 45%? It's a sure bet for failure. So we're going to see a slowdown in real sector economic activities, while we're going to see people moving towards incomes that we call passive income. People who have resources. Assuming you have a 1 billion Naira, even 100 million Naira today, and you go to your bank and you buy bills at 21% or 20%, for instance, you are sure that at the end of the year, you have 20 million Naira. Most people do not have 20 million Naira as annual salary. So if you have 100 million Naira alone, you can as well be drinking coffee and playing golf in the Quake Club at the end of every morning. But that's just to say that every economic policy has a positive and negative. So coming from this is just basically the agenda, but let me now go to further, let me dive deeper into the global economic trend in Q1. I had mentioned earlier that the IMF had predicted the global economy to grow at 3.1%. World Bank is predicting 2.4%. IMF prediction is based on the fact that the US has become quite resilient and that China is growing. Other emerging economies in the world, including India, are also growing. And as you may know, India has become the 4th largest economy in the world. After the US, China, I think you have Germany and then you have India. And as it's going today, so with the likes of India growing, it's kind of propelling global economic growth. So if you look at the graph by your right, you will see World Bank projections of growth across the globe. You can see Nigeria's projection is about 3% for 2024. Last year, he had projected that Nigeria would grow about 2.8%, but Nigeria grew up 2.74%. Okay, I had also mentioned to you that the US economy grew about 3.1%, but UK suffered a contraction in Q4 2023. In Q4 2023, China grew at 5.2%, which was an improvement over the 4.9% it grew the previous year. And the 5.2% was also better than the expectation that China will grow at 5%. So they actually outperformed global projections. Global inflation is moderating. We've seen average inflation projected at 5.8% in 2024, and further decline in global inflation to 4.4%. And this is even Ghana is seeing a moderation in inflation rate, but unfortunately, Nigeria is still seeing an uptick. But our projection is that inflation begin to moderate in Nigeria in the third quarter of this year. But we'll come back to that. Inflation in UK had declined 3.4% from 4% in January. Canada inflation has dropped to 2.8% in February. Then the Euro area had inflation rate of 2.4% in March, down from 2.6%. And the United States, unfortunately, had a reverse. The US economy, inflation, consumer prices moved 3.48% or 3.5% approximately, from a 3.15% or approximately 2% in February. So at the graph there, you have the forecast growth across the regions. The emerging market and the developing economics is projected to grow at 3.9% in 2024 from 4%. That's a minor decline. Sub-Saharan Africa is supposed to grow at 3.8%. That's where Nigeria belongs to. But if you look at Nigeria's growth, so Nigeria is actually among the countries that will be dragging down the Sub-Saharan African growth, because Nigeria's growth is projected at 3.0%. You have Middle East and North African countries, where you have the likes of Egypt, the United Arab Emirates, and so you have a projected growth of about 3.5%. The global, and then you have the Europe and Central Asia. You have South Africa at 1.3%. You have the advanced economies at 1.2%. This is the inflationary trend. We've seen Ghanaian inflation moved from 23.2% in February, in January, to 23.5% in March, but it had actually dropped earlier from January to February, from December to February to January. Nigeria has continued to see consistent increase in inflation. I did mention that the report published yesterday, inflation was 33.2%. Okay, now let's move on to a review of our local economy, because that's where most people's interest is. So on that, we share common interest. In 2023, Nigeria's GDP recorded a positive growth of 2.74%, or 76.68 trillion naira in the GDP. That's adjusted for inflation rates, using a base year of 1990. But this growth was in spite of increasing level of unemployment and challenges with foreign exchange we had last year, disruptions in price levels, uptick in energy costs. But however, the economy managed to grow at 2.78%. But this is a consistent decline that we're witnessing over the past 3 years. In 2021, it grew by 3.4%. In 2022, it grew by 3.1%, and in 2023. So if you look at the trend, you get worried because a trend could be indicative, symptomatic of other larger issues. But in Q4 2024, 2023, quarter on quarter, the economy grew by 3.46% in real time. The non-oil sector was basically the propeller of that growth at 3.07%. Interestingly, the oil sector recovered after several quarters of being in the doldrum. So just to give you an idea of what drove the Q4 performance, you have services at 3.98%, primarily from insurance and finance and insurance, which was grew by 29%. And that was the fastest growing sector in Q4 last year. ICT was 6.3%. Agriculture sector grew by 2.1%. But for the whole entire year, it grew by only 1.13%. Oil sector recovered from many years of 3 years of contraction and grew at 12.1% because we saw an uptick in crude production to about 1.55 million barrels a day. The sad news is that has now begun to taper. There is beginning to see a slowdown or a decline in crude production. We'll come back to that. So this is how the economy fared in the entire year. If you look at that, you have agriculture sector accounted for 25% of the total GDP. The sector grew by only 1.13% for that for the entire year. And then in ICT sector is the second largest contributor to the economy, and that sector grew at 7.9% for the entire year. Of course, 6.3% in the last quarter of last year. And then you're followed by trade sector. Trade sector accounted for 15.8% of the GDP, and that sector grew at only 1.66%. You can see agriculture accounts for a quarter of our total economic activities, but growing at 1.1%, that's obviously dragging down the entire economy, and that's why the economy grew at only 2.74% for last year. We saw a major contraction in transport and storage. Of course, we know the issues around fuel scarce, increase in fuel costs, reduction in rail services, particularly rail services going to Kaduna and stuff like that. Headline inflation, there's actually no overemphasizing the issue of inflation in the country because this is where it hurts. Inflation had moved to 33.2% in March. Food inflation is at 40%. And for most households in the country, food inflation is actually the measure of inflation for them because it's, if you look at the basket of an average Nigerian household consumption, food alone accounts for more than 60% of their consumption. So an uptick of 40% in food inflation is why people are saying we're not feeling whatever economic policies that the government has put in place. So this is just a graphical illustration of the way inflation has gone over this period. So, of course, any response central bank will react to the high inflation pressure. And the central bank has responded aggressively to inflationary pressure by hiking monetary policy rate. That's the benchmark rate from 18.75%. It was increased in February to 22.75%. And in March, again, it was further increased to 24.75%, summing up to about 600 basis points or 6% increase in an attempt to rein in on inflation. The central bank also increased the cash reserve ratio, which is the proportion of a bank's deposit that is kept by the central bank at no cost to central bank or no benefit to the banks. The central bank also increased that to 45%, but it retained the liquidity ratio at 30%. Of course, the implication of this is that we are beginning to see a moderation in exchange rate. We've seen a material moderation in exchange rate, but inflation is yet to reflect on inflation. But our take is that by the time you get to the inflation will peak in the second quarter of this year and then begin to moderate in the third quarter of the year. So in terms of other central banks' response to interest rates, we saw the Bank of England keep Bank of Ghana keep benchmark rates at 29% in March. It had actually cut benchmark rates by 100 basis points in this meeting in January. So it was from formerly 30%, but it had dropped it to 29%. But the inflation rate in Ghana has moderated to 23.2%. So in effect, inflation rate in Ghana is actually lower than Nigeria's inflation rate. And you can actually see where Nigerian central bank is also taking its deal book from, to look at what Ghana has done to rein on inflation and maybe taking the time route. Egypt Central Bank also maintained interest rates at 27.25% in March to support economic recovery amid global slowdown. Of course, Egypt is in an unenviable position that pressures or tensions in the Middle East between Israel and Hamas, and now Israel and Iran will have direct impacts on the economy. Then the Reserve Bank of South Africa kept its rates at 8.25% in March, while as the Kenyan Central Bank raised interest rate to 13%, the highest so far since 2012, all in a bid to support the Kenyan shilling. Now, another issue that's of interest to Nigerians who are familiar with economic issues is the issue of national debt. We saw our national debt increase by 110% year on year in 2023. We saw a national debt that has now topped 97.34 trillion naira. Of course, that a large chunk of that is owed by the federal government. If you look at that, you see the federal government debt, domestic debt is about 53.26 trillion naira, which is about 61% of total domestic debt, while our state governments and FCT domestic debt is only 5.86 trillion naira, which is about 39% of global debt, of local currency debt. But interestingly, if you just talk of the debt profile, you need to recognize that the cost of servicing the debt is actually the bigger problem. If you look at this schedule, you realize that actually, if you look at the chart, you will see that in 2023, domestic debt service was 4.4 trillion naira, while as external debt service was 3.5 trillion naira. So if you have to convert the external service to naira, you will now observe that Nigeria spent more than 80% of its total revenue, because if you consider the fact that as at September last year, total federal government revenue was 8.65 trillion naira. And if you sum up these two, you have about something like 9.3 trillion naira. But interestingly, the federal government is projecting total debt service of only 6.56 trillion naira for this year, which we think is overly conservative. Because if we spend 4.4 trillion naira and we have borrowed another 2.7 trillion naira from the financial market, from the financial system at average of close to 20%, then means that we have added another 2.4 trillion or 2.5 trillion to our national local currency debt servicing. If you add that to this, you have about 6.8 trillion naira. If you add that to about 4.9 trillion naira, when you convert 3.5 trillion naira, you are obviously pursuing 12 trillion naira as your debt service for this year. So we think the debt service is going to be for this year would materially higher than last year, and the figure budgeted was an understatement, which also means that the debt service will further crowd out government resources for investment in critical sectors of the economy. Then let's look at the oil production. We've seen oil production begin to taper, which is also another problem, like I mentioned earlier, that we saw an increase in oil and gas sector oil sector GDP growth about 12.1% in Q4 2023 because of an increase in crude production. But unfortunately, since that point, crude production actually plateaued in January at 1.64 million barrels a day. And since then, we saw a decline at 1.54 million barrels a day, and a further decline to 1.44 million barrels a day. And these are indications of the fact that the challenges around crude production in the country has not been fully addressed. The Minister of State for Petroleum Oil said that the decline was a result of issues encountered on Trans-Niger pipeline and maintenance activities carried by some of the oil companies. But we think is bigger than that because these are talking about 3 months of consistent decline, which actually puts a question mark on our ability to sustain the naira appreciation that we've seen in the past couple of weeks. The other thing I need to mention is that we've seen the geopolitical tension we're seeing in the Middle East now has a way, depending on how deep it gets or how quickly it resolves, has a way of affecting oil prices because that's Suez Canal is a major export route for oil that is coming from the Middle East to other parts of the world. So if there is war between between Iran and Israel, if it now snowballs into a real war, then it simply means vessels won't be able to go through that, and we should expect a major uptick in crude prices. If that happens, Nigeria will be worse off instead of being a beneficiary, because from what you can see now, we are not able to increase our crude production. And ordinarily, we should benefit from any major uptick. And given the fact that we are still importing and refined petroleum products, so we'll be paying more for refined products without a commensurate increase in export earnings coming from our crude exports. Well, I did mention earlier that the central bank had to react or respond to the increase in exchange rates that we saw, where the exchange rates moved from as high as low as 1,215 naira at the parallel market to 1,900, and then at the official window, it moved from about 907 naira to about 1,627 naira to $1. So central bank came up with several of policy pronouncements to rein in on naira depreciation or naira devaluation. So these are some of them. Inflation targeting framework, adoption through interest rate hike. The latest one is that the central bank has actually banned banks from using foreign currency denominated collateral as foreign currency denominated assets as collateral for naira loan, other than federal government issued Eurobond. But I think the banks are still negotiating with the central bank on that as in relation to Nigerian corporate issued Eurobonds. The central bank and the DMO had mobbed up 12.7 trillion naira between January 1st, 2nd, and April 15th this year, all in a bid to stabilize the exchange rate. And we're seeing the impact on naira rates. I did mention earlier that we've seen naira appreciate to 1,080 at the parallel market and 1,130 at the official exchange rate. So you can also see we have seen a convergence in rates between the parallel market and the official window. Now, what are those other factors that could drive stability in exchange rate? I had mentioned the issue that we are still dealing with a declining crude oil production, which is at the heart of stabilizing the exchange rate. So what we're doing now is that monetary authorities are using monetary tools, particularly high interest rates on fixed income instrument to incentivize capital flow into the economy. And but the other options that you look at is that if you look at capital importation in the country, you realize that entire of last year, until the central bank introduced this aggressive incentive to foreign portfolio investors, the entire 2023, only $3.9 billion came into the economy as capital importation, a decline of 26.7% when you compare that to the figure that was received in 2022. So we are looking at where did those capital importation come from? But interestingly, we've seen a reversal of that in the first quarter of this year, which I did say earlier that the high interest rate, in fact, in February this year, we saw a major improvement in foreign portfolio interest in Nigerian equity instruments. We saw foreign participation at about 118 billion in February this year. And that was driven by, obviously, information they had that the central bank was going to resume defending the naira, and that it's going to drive towards a naira appreciation. So they took position to do get two things. They carry benefit of buying, converting dollar to naira at a time when naira was going to appreciate. And let me give us a clear graphical illustration of what we're referring to. Assuming a foreign portfolio investor brought in $1 million in February and was able to exchange the dollar at 1,500 naira to a dollar, he would have brought in 1.5 billion naira. So if he brought in 1.5 billion naira, which is what he invested in Nigerian instruments, even if it was an equity instrument he invested in, and even if he makes just 5% or 10% capital gain, so if he makes 10% capital gain, he will have another 150 million naira, which takes him to 1.65 billion naira. Then if he has to exit at a time when the naira goes to 1,000 naira, which is the direction we're looking at, then his $1 billion becomes, he would demand from this economy a sum of 1.65 billion naira. And that's why they jumped in quickly into the equities market. And now they are moving into the fixed income space. So we must also recognize the cost of the naira appreciation that is induced by central bank and not induced by market forces of improvement in supply from our operational activities. Operational activity for the country is your export. So we know there is a cost to what we have achieved as a people. Well, this is just to show us where capital inflow comes into the country. The UK still remains, of course, UK is highly, and the UK investors are highly level about Nigerian opportunities. And they are the first to know what was going on, what goes on. And that's the largest country of the largest source of capital importation into the country. About 29% of our capital importation into Nigeria comes from UK. Or sometimes you see investors from other countries use their London office to invest in emerging economies like Nigeria. The other thing I want us to touch on is the banking industry consolidation, which is a topical issue. I'm sure you know on March 28th, the central bank came up with the expected capital requirement for banks, and among which was that global banks or banks with international operation will now require 500 billion naira. Local banks with national operation will have 200 billion naira. Regional banks will have 50 billion naira. Merchant bank 50 billion naira as capital requirement. And then you have non-interest banks at national and regional levels. We have 20 billion and 10 billion respectively. And the banks have 2 years between now and March 2026 to meet that new capital requirement. The snag in these capital requirements is that the banks are not supposed to count their revenue reserves and other reserves other than the revenues have another reserves other than their share premium in determining their share capital. So So I have spoken extensively on that in different fora. I believe it's wrong-headed in the sense that the retained earnings are the earnings of the shareholders. They are what could have been paid as a dividend. So if any bank is prudent enough to want to keep, instead of blowing its profits, it decides to keep it in the business, you cannot say it shouldn't count as your capital. But that's not the conversation this afternoon. So the basic thing is that the banks will now need to raise additional capital. If you look at the table there, that is based on the last audited accounts of the banks, their share capital and their share premium, and the new capital requirement they need to meet, whether they are international, operating globally, internationally, or locally, and then the amount of money they need to raise. Now, let's quickly look at the equity market space. We saw an equity market gain 39.8% in the Q1 2024. We've seen this kind of gain, which was coming just after a 45.9% gain last year, and when the market gained year to date of 45.9%. So, in fact, the equity market was able to breach the 60 trillion naira mark. But if you look at the graph there, you will see what the market did in each quarter. The left graph, you see that the market gained 39.8% in Q1, coming from a full year of 45.9% last year. And Q3 was 29.5%. So, but the basic thing is that we are beginning to see, we saw an uptick in foreign portfolio investment in equities, but a slowdown in local investors' interest in equities, that local investors started switching to fixed income instruments as well as dollar assets when Naira was at its worst performance. But now Naira is adjudged as one of those with the best performance. But like I mentioned, it has to come with a huge cost to the economy. I've spoken extensively on that we saw an uptick in foreign portfolio investors' interest in equities, largely because they had information that Naira was going to, Central Bank was going to start defending Naira, and then Naira was going to appreciate, and they needed to take position on both ends. So they may end up taking up monies far beyond the amount they brought into the economy, which means Nigeria is digging a hole if we are not careful how we manage this Naira appreciation at the speed we have recorded it. I'd also mentioned that for the local investors' interest waned, and we're beginning to see the impact of that as the market has become bearish. These are the major gainers and losers in the first quarter of this year. Julie gained 1,508%. You saw Geregu gain about 150%. You saw Dangote Cement gain about 114%. The worst performing was Morrison, that lost at 7%. You have the likes of Guinness, Dark Communications, CNI Leasing, at the receiving end. This is just to show us some of the challenges that business operators have encountered last year as a result of the sharp devaluation of the currency. Recall that when Naira was harmonized, it moved from about 438 Naira to $1 to about, and ended the year at about 907 Naira at the official window. So those who were holding net negative open position in dollar and in foreign currency had to lock in exchange losses. But this, in terms of this, what we have here are the exchange losses of some of the big operators. But the First Bank won't have to take them out, because First Bank also had about 600 million gain, which is reported as a different item. So if you adjust for that, First Bank will actually have a positive exchange gain about 300 billion. So it shouldn't count in determining this. But the rest are institutions that recorded negative exchange report or foreign exchange losses. And you can see the impact. So like I said, I judged for First Bank because they had revaluation of assets here to adjusted in the P&L of about over 600 million. So, but other than that, you can see the impact of that on most of the companies other than Dangote Cement that still recorded a profit of 455 billion. Now, the sectorial performance in Q1, we saw the banking industry appreciate by 14%, 6%. We saw the leading banks, Wema Bank recorded the highest gain, 51.8%. First Bank actually got as high as 14 naira to per share, but unfortunately it has come down to about 27 naira per share. But like we said earlier, the banks are actually the ones who are enjoying the tailwind effect of the exchange rate movement. And therefore, their profits, because of exchange rate gains, most of them actually have positive net open position, dollar open positions, which were revalued at balance sheet date to generate higher exchange gain. So these are the foreign exchange gains of the banks. You can see what I meant in First Bank. You can see First Bank, they had a foreign exchange gain of 651 billion. So if you take out the 350 billion, so the First Bank still had a positive foreign exchange gain. So you can see Access Bank foreign exchange gain is 629 billion, Zenith 228 billion. You had First Bank, I mentioned First Bank, you had UBA, you have JITCO, which is Guaranteed Trust, and you have Fidelity. The industrial goods sector, the major operators there are Dangote Cement, which recorded a share appreciation of 115% in the first quarter of this year, from 319 naira 90 kobo to 686 naira 70 kobo. Bua Cement also recorded appreciation of 67.7%. These are despite the liquidity, the FX challenges and the sharp increase in cement prices that may have affected demand. So the fast-moving consumer goods and the FX losses, you can see the people that the Nigerian Cement recorded major FX loss, which led through its profit to negative. Oil and gas sector. Of course, there's only one upstream operator that is quoted as Seplat. So Seplat is also a diversified energy operator because they are also quite strong on the gas. So they have their operation was not much impacted by the deregulation of the downstream sector because they don't operate in the downstream sector. But with increase in gas price, which I'm sure you're aware of, so it's likely going to see a further improvement in its earnings. MRS recorded screening profit improvement because volume of turnover because of movement in price levels of white goods, or what they call refined petroleum products. That cut across all of them. Other than Etana had the challenge of dealing with a negative foreign currency open position that led to it recording exchange loss, contrary to what most operators in that sector did. Fixed income market and money market. I'll quickly run through this because we're running out of time. I had mentioned to God that the federal government over time, since the beginning of this year, has issued more than 3 trillion naira in bonds. And because of the rate at which those bonds are yield, we saw a bearish market. Bearish market means prices went down, yield went up. Because new offers were coming at this, and people who were interested in money market, in fixed income instruments, were rather staying in the short end of the market where they could get the effective yield of more than 20% from the treasury space. So we saw them rather prefer that. So federal government had to come to the market to issue new bonds at yields of in the region of 19% in March. to compensate investors or incentivize investors to invest in those bonds. This is to give you an idea of how much bonds that were sold. If you add the bond that was sold yesterday, so you will come to about 30 trillion naira. But this was at the end of the first quarter of this year, where total sales were about 2.38 trillion naira. Total subscription was 3.1, and total offer was 3.3. So if you look at total offer and total subscription, that will also give you a message that investors were not so aggressive with bonds, unlike the level of aggression they showed in buying shorter dated instruments in treasury bills. Nigeria's euro bond, because of expectations of capital flow into the economy, we saw Nigerian euro bond price trend northwards and yield moderate. But when the federal government announced it's going to come to the market and issue domestic bonds denominated in foreign currency, we saw a reversal of that trend. So the federal government has said they will issue foreign currency denominated local bonds in June, and that are all aimed at shoring up the naira exchange rate by boosting foreign currency liquidity. And obviously, that may also be to prepare for exits of foreign potential investors, because what we believe is that once they think they have made good money or they think naira appreciation has plateaued, then they are likely going to begin to exit, and that will put a lot of pressure on the exchange rate. So this is just to give you an idea. I've spoken of this, that the auctions, the TB's auction at some point went as high as 21.49%. The last auction which was on Friday, was at 20.7%, which also may be indicative of the fact that the central bank is beginning to taper the yield on treasury bills in view of the high cost or high burden of servicing such level of debt. We have about 6.9 trillion that had been withdrawn by federal government by way of issuance of treasury bills since the beginning of this year. What are the macroeconomic outlook? Let's start with inflation. We think inflation will begin to moderate in the second quarter of this year. Two things. We expect that the effect of the pass-through effect of naira appreciation will begin to manifest when traders begin to restock their warehouses and their ships with import at lower exchange rates. So we should expect that in the next 30 to 60 days, imports that were made at the new exchange rate will come into the economy. The other factor we think will begin to manifest in the second quarter of this year, towards the end of the second quarter of this year, is what we call the lag effect. No, sorry, the base effect. The base effect is that if you look at the fact that the major uptick in inflation began to manifest in June last year. So by the time you get to July last year, you're going to be measuring inflation from a higher base. You are going to be measuring further increases from a high, already elevated prices. So at that point, the base effect will kick in, and we think come from July, we should begin to see a moderation in inflation rates in the country. As long as the central bank continues its tightening posture, denying the economy of liquidity, we should expect naira. Naira will remain relatively stable. We think the appreciation of the local currency is beginning to run out very soon. But before we talk about, so in terms of interest rate outlook, we think rates will remain high in the next quarter of this second quarter of this year, because central bank, even when want to begin to dial back, they're going to do it at a moderate rate. We've seen a situation where major Nigerian corporates are coming to the market to borrow by way of commercial paper, what we call it disintermediation. The likes of Flamis are coming to the market to borrow about 25%. Dangote Cement is coming to the market, borrowing at about 25%, or they're about 23.5% to 25%. The implications of this is that the banks will also have to struggle or contest for deposits with these corporate that are going directly to the depositors to take money from. And that means the banks are going to offer, particularly large ticket depositors, higher interest rates. Given that this commercial paper yield and yield on treasury bills have created alternative investment outlets for depositors. So we think interest rates at the deposit level will increase. We think interest rates opportunities, incoming opportunities as well as interest investment in money market instruments will increase with bank companies coming to raise commercial paper. And we think interest rates at the bank deposit level will also increase. The exchange rate, we think the application in the country is going to, of the local currency is going to soon run out its steam because of the high burden or the high cost of financing that appreciation. So what we have seen is a situation where you can say that the government has eaten back its words when they say we're deregulating. Of course, we know that the fact that the central bank is selling dollar to the BDC and continues to come to the BDC and sell at a lower rate anytime they come simply means the central bank is intervening to drive down exchange rate. The fact that the federal government has borrowed 12.7 trillion naira from the economy, which was not invested in any productive activity, also further proves that the federal government is intervening to show up the value of the naira. But like I've explained succinctly, that's a huge cost to the economy. So we think at some point, if you look at the trend in yield on treasury bills, after reaching 21.49%, the central bank came down to 21.12%. The next auction was 21.12%, and Friday's auction was at 20.7%, which means we are seeing a tapering in the yield on treasury bills, which is a trend now. So if that continues, it must show that the central bank capacity to continue to borrow from the money market to show up the currency will also moderate. But the greatest fear, the greatest concern is actually that crude production is not improving. We saw a crude production of 1.64 million barrels in January that dropped to 1.54 million barrels or 5.53 million barrels in February, and further drop of 1.43 million barrels in March. So, and that is the main core of our operating cash flow as a country. What are the market outlook? I think I've spoken this extensively. We think that given the current valuation of some of the stocks, given a shift in portfolio construction away from fixed income, away from equities to fixed income, that we should, and given the fact that apart from the banks, many other business operators, quoted companies, did not see material improvement in their earnings. Some actually saw a decline, some actually turned negative. So, which means the yield expectation, the return expectation by investors may not be met. So we see investors who may be disappointed with the dividend yields, given the price at which they bought the stocks, and they will begin to unwind. So we think the equity market will witness a further southward movement in second quarter of 2024. The fixed income space, I think I've spoken extensively on that. The central bank has been quite aggressive in that space, and there is just a limit to what it can do. Yesterday, there was an auction that of about 900 billion was raised. So these are all adding up to the cost. But I think the federal government will and the central bank will, as much as possible, try to maintain high yield on fixed income space so that those who are coming will want to continue to roll over their investment, at least in the short to medium term, hoping that crude production will recover to prepare Nigeria to be in a position to pay that. Of course, I mentioned that the federal government is coming to the market to issue dollar-denominated local currency bond, so as to incentivize further capital injection into the economy that will help us stabilize the exchange rate. So on that note, I want to thank you for listening. Cowry Asset is your partner in wealth creation. We've been around since 2005. We will be 20 years next year. So we are 2 decades old. We have a track record of successful advising companies in capital issue, capital raising. We manage a portfolio. We help you invest in a cross-section of instruments, starting from local currency bond, local currency treasury bills, Euro bonds. We have about 5 funds. We have fixed income fund. We have a mixed fund. We have an equity fund. We have a Eurobond fund. We have also a dollar note. So we have all instruments that will meet to the fancy of any investor who wants to create wealth. Thank you for listening. I'm available to take your questions.
Thank you very much, sir, for the presentation and as well as the excellent delivery. We have some questions here. Someone is asking that the way and manner the Naira fell in the past few months, are they not induced? Is it something that can last the test of time? You had earlier spoken about that, but if you could just reiterate for the person's
okay, just for emphasis, like I said,
yes, for emphasis.
Like I said earlier, it was clearly the kind of offer that the central bank made in terms of treasury bills, with the treasury bill yields of as long as high as 24% when you look at the effective yield on a discounted instrument at 21.49%. So it was incentive for investors, and investors also knew that there's a carry effect of converting to Naira at the time when Naira is going to appreciate. And therefore, I even use a graphical illustration on the implication of somebody who brought $1 million into the economy at 1.5, 1,500 Naira to $1, and we want to take out when it becomes 1,000 Naira to $1. So it was clearly induced. I also did emphasize that we have not seen any material improvement, not even material improvement in our source of operating cash flow, which is our export of crude. Yeah, Miracle, you can go ahead.
Okay. Someone else is asking here about the recapitalization of the bank by the central bank. They are asking what is the best move to take at this point in time? Is it time to buy or to sell the banking stocks?
Okay, what I would say is that it depends on which stock you want to buy. We're not going to give you a blanket advice because that is not professional. So you may need to talk to us so that we can know exactly where your interest is, and so we can advise you. It's not every banking stock that we can tell you to buy. It's not every banking stock we can tell you to sell.
Yes, that's very correct, sir. Thank you. Someone is asking here, how soon will the multiplier effect of the falling of the Naira affect the prices of goods and services? How soon can we say we'll feel this impact?
My back of the envelope estimate is it takes about 60 days because of the delay we have in clearing goods at the seaports. So because assuming somebody bought dollar at 1,200 last week and went to place an order for goods, one of the things that happened also, the traders are also slowing down to know when Naira will plateau. So they are not in a hurry to buy dollar immediately to go and place fresh orders, because if they buy and dollar falls further, they're in trouble. So they're waiting to see when it plateaus. So when they think the appreciation has stabilized, and they buy dollar at that point, so it gives it another 30 to 60 days because of the delays we have at the seaport. Ordinarily, it should have been a shorter period. And then for manufacturers, the manufacturers are content with beyond the issue of cost of raw material, input materials. In because they are importing their input material, they are borrowing at higher interest costs. So the interest cost element partly offsets the benefits of the lower exchange rate for them. But for ordinary traders who are trading with their own money, they are waiting to know when they think Naira appreciation will stop, and then they will buy, because like I said, if they buy earlier and Naira appreciate further and they bought with the price they bought, they will still take losses. So ultimately, when we see some level of slowdown in the appreciation, it will take it another 30 to 45 days for those goods to come in. And once the goods begin to come in, what's happening that people who have goods, they imported at higher exchange, they are refusing to drop price because the dropping price simply means they are taking losses. But it's only when new goods are imported, and those new goods imported at lower exchange that are competing with those who have existing stock. The people who have existing stock have no choice. We have no choice than to begin to sell at the new market prices.
Yes, that's very correct. Okay. Someone is asking, well, this question says, where can one see the various investment options your company engages in, as this cannot be seen on your website? Okay, well, actually, it's on our website, but probably we'll just navigate you through where to see this by the end of the webinar session. Someone else is asking, what is the reason for the reintroduction of the fuel
Okay, in
subsidy?
addition to that, if you go to our website, just in case you need a quick response, just call our contact numbers there, and somebody will quickly take you through where you can pick information on our website, or will assign you to an account officer that will guide you in your investment journey.
Yes, and in addition, you could also send a mail to our official email address at info@cowryassets.com to get sorted out. So, sir, the question of the reintroduction of the fuel subsidy, please, could you speak to that?
Okay, in terms of the reintroduction of the fuel subsidy, it just happened because when the government deregulated downstream sector, they used an exchange rate of 715 naira to calculate the pump price about 518 naira then. The exchange rate has moved far beyond the 715 naira to $1. So, which then means that if you import at the higher exchange rate, the landing cost will become higher. And because Nigerians were already shouting and screaming, so it became difficult for government to adjust it. You know, they had adjusted the pump price after the initial movement. So it became difficult for them to adjust. So the government began to absorb the differential, and that made it impossible for any private operator to import fuel. So everybody now relied, all the traders now rely on federal government import. Because of that, cost differential of landing the products as a result of movement in exchanges. So the major challenge was movement in exchange, not necessarily movement in ICE or international price of refined products.
Okay. There's a question here, although you had answered it earlier about the recapitalization of the banks. Someone is asking, would there be a benefit or incentives to shareholders of these banks going forward?
Well, it may be delayed in the sense that until the economy can generate enough economic activities for the banks to fully deploy the additional capital that they will generate, you may have an initial stage of suboptimality where they are carrying excess capital, but ultimately, as long as the economy expands, eventually we see opportunity to invest those capital, and that's when they begin to generate commensurate return on the investments on the additional capital.
Okay. With the artificial strengthening of the naira not determined by the market forces, what potential effects could it have on strategic planning or economic forecasting for local businesses?
Well, I think that's the benefit of the gatherings of this nature, where you have this webinar, where it's clear to you that the appreciation is not driven by improvement in our operating cash flow. So it then means you have to take a timing where you can take a position. One, if you have an open position in a foreign currency, it's an opportunity for you to close that open position and free yourself of any possible future devaluation. Then if you have an immediate need, it's an opportunity for you to also meet those needs now that is seem to be liquidity and lower exchange rates. So that's the benefit of having a strategic meeting of this nature.
Okay. Someone is asking about the Dangote refinery. What will be the likely net effect of Dangote's diesel now in the market and the PMS coming in next month?
Well, I think what will happen is that the prices will still reflect what happens globally, because remember Dangote is largely now importing his crude. So it will, if he imports crude and refines, so it then means that the prices we're going to get will still mirror to some extent international prices. But while we may have improved availability, you may still have some level of adjustment, improvement in the cost. But I don't see a sea change, because we are not supplying Dangote the crude. I did mention that we are seeing a constant decline in crude production. So Dangote cannot rely on Nigeria crude. Remember that Dangote is 650,000 barrels per day, single train refinery. Nigeria in March produced only 1.4 million barrels of crude per day. So if Nigeria can't afford to give Dangote the 650,000 barrels, there are also commitments on those current production. We know that there are some forward sales the federal government had done to raise money in the past. They are encumbered productions today. So we really don't have a free crude of 650,000 barrels. As long as Dangote continues to import, so you import the crude at international prices, and then we have to sell a price that will allow him to recover his cost.
Okay. Someone here is asking about how to delve into bond purchase and shares. We have a stockbroking arm, that's Carry Securities Limited, that is in charge, or that is saddled with the responsibilities to buy and on behalf of our clients, given the mandates they have with us. So if you send the email that we had earlier mentioned, you could send an email to the email address info@cowryassets.com to get sorted out, and we can take it up from there. Someone is asking, which investment portfolios do you advise investors to go in of the time we are in?
Well, that's a specific question. My approach to advising investors that we need to do your head profile. One of the things we do, which is what stands out as an investment house, is that we don't just give flippant advice. We will look at your investment objective, we look at your source of funding, we look at your cash flow, we look at your stage in life, and then we'll advise you of investment options. One, that will make sure we don't expose you to risks that you cannot bear. Two, that will maximize your return. So if you can reach us at info, or reach me directly, or any of my colleagues, if you know any of our name, the first name, the second name in full, like my name is Johnson Chukwu, so my email is jchukwu@cowryassets.com. So if you know any of us and you know the full name, and the first name and the surname, the first word of the first name, and the full second name or surname, and then at cowryassets.com, or just go to info@cowryassets.com, and then we'll attend to you specifically.
Okay. Someone here is interested in the merger between Dangote Sugar, Nascon, and Dangote Rice. They're asking if you could give your opinion, or if you could shed some more light as to this proposed merger.
Well, I think what Dangote is doing is cost optimization, which is basically, these are all part of the Dangote food, similar to what Bua did, where they had made their food-related business into Bua food. And therefore, they're going to eliminate overlapping costs and attain some level of cost efficiency that will improve the bottom line. So I think that's basically what is driving it.
Okay. This question has been answered before. What is the effect of the appreciation of the Naira, and why has positive effects on prices of goods and services not yet been felt? As he had earlier explained, based on the new stock coming in, you should consider about 30 to 45 days when the new stock comes in, giving the new exchange rate, to then consider the price volatility. Someone else is asking here about the app. Do we have an app? And if we do, how can you use that app for trading?
We have, if you are a customer, you can actually trade with your phone. So we'll give you access to do your trade with us. So if you're not our customer, if you go to our website, you can actually onboard you. Just fill some basic forms and then we'll onboard you and we'll give you access to use our system to do all your trade, to do your basic research, get information on everything we share here and what we share on a daily basis. And so we are available to you at a virtual platform for your effective trade.
Okay. So someone else is asking if we could train people on how to use the live trading platform. The live trading platform is actually a user-friendly platform, but nevertheless, if you encounter any challenge, you could always send us a mail at info@cowryassets.com and we will definitely put you through. So thank you very, very much to everyone who has taken our time to join. Okay, I think there's a last question here saying, please, how can I get my login details? I have an account already with you, but it's been a while I used it. Okay. You can also send us a mail and we get the password reset and login details sent to you. Thank you to everyone who has joined, we appreciate everything, and we would like to call on one of us, Folake Osho, to give us the vote of thanks.
There's also a poll there for you to complete. So I'm sure there's a poll on your screen. If you can quickly complete that, that will help us to improve the webinar usefulness to you going forward. Thank you. Folake, you can go ahead.
Okay, thank you very much, Miracle. On behalf of the entire team at Cowry Asset Management Limited, I would like to express our sincere gratitude for attending today's webinar on the Nigerian Economic and Financial Market Review. Your participation and engagement were instrumental in making the event a success, and we're delighted to share our insights and have a productive discussion on the current market landscape. We hope that you found the presentation from the MD of Cowry Asset valuable and informative. The presentation slides will be shared immediately after the webinar is over. Thank you very much for joining in today. Do enjoy the rest of your day.
Thank you. I'll see you again at the end of this quarter, or at the beginning of the third quarter of this year in July.
Thank you, everyone.